talk, in a sense, is a transition from the discussion of the European model of the last session into discussion of some of the Irish issues to follow this afternoon. Looking at Ireland through the lens of the Nordic economies and societies, the social democracies of Denmark, Finland, Norway and Sweden in particular. But there are varieties within the Nordic models, and that in many respects the social democratic model is compatible with countries that depend on large industrial companies like Sweden versus countries like Denmark that depend on an industrial structure of really small firms. Some political systems operate quite formal institutions, others depend more on informal negotiation, and so on. Okay, so oftentimes we think of the Nordic model as high social spending, strong degree of distribution, social distribution of income from the top to the bottom, and so on. And it's certainly, I think, the case that social protection and very high levels of social protection is at the core of the social democratic model. At the same time, very high levels of services, more so than transfers, generally speaking, services that are available on a universal basis, and certainly depends on high rates of taxation as well. But behind that is a set of institutions and arrangements that are not as widely recognized. And I think there's a number of those. One is very high participation rates in the economy by the labor force. So Denmark, for example, peaked at around 78% of people in employment in the relevant age groups in the 2000s, and it's back now around 72-73%, but much higher than Ireland, as we'll see. So in that sense, to paraphrase Bill Clinton, the dependence on welfare should be strongly supported, universal, but relatively rare. So and in a sense, the high quality universal services depend on that very high level of labour force participation. On the other hand, that's also supported on the other side, on the bottom there, by the productive dynamism of industry and the economy in general. So that the competitiveness of the Nordic countries in all of the international indices is not just a byproduct, but is actually a key element and a key focus of those countries. So there's a consistent emphasis on wage competitiveness, but also on increasing productivity, innovation, and so on. And the kind of high labour force participation and the dynamism of the economy are interlinked. And in particular, I think that it's important to see that the social investment, which is so prevalent within the Nordic economies, doesn't happen despite the competitiveness, but is actually a key integral element of it, as we've heard this morning. Two other elements. I think one is when, with the exception of some notable periods, especially in the early 1990s, there's a financial system which tends to channel funds towards productive investments rather than towards speculation. And the final element is a state and a set of public institutions which works to knit all of these different elements together through kind of high quality public services to population and also to the economy, to business. It's a very large state, but it's fiscally large, but also fiscally conservative, tending not to run budget deficits and so on. So in a sense, those are kind of key elements to the Nordic model. I just want to emphasize two other key dimensions. One is that the social and the economic are firmly integrated within this circle. And the other is that there are kind of stabilizing elements with strong levels of social protection, but also limits on financialization when the model works, as well as the kind of more dynamic elements of high rates of participation constantly being regenerated through the dynamism of the economy. So it's a little bit of a balancing act, but one that appears to be quite sustainable. And I think it's worth re-emphasizing the point that Anton makes in his paper in the book, which is that the social protection dimension and the social investment are in fact intertwined. They're not substitutes in this model, but the kind of dynamism that's driven by the social investment is counterbalanced by the kind of stabilizing effects of social protection. What does this look like then in Ireland going through these different dimensions? Looking first at social protection, we do have universal elements to our welfare state, but it tends to be universal at a very low level, and then after that quite segmented. So we end up with, in a sense, quite a polarized welfare mix. On the one hand, we have strong levels of transfers, I think also we discussed this morning, for those who are marginalized from the labor market, for those who are socially excluded. Transfer payments show up in the statistics as transferring a large proportion of the population out of poverty, certainly out of enforced deprivation, up the scale into what I think we might call is less severe deprivation, but with relatively weak services. And on the other hand, for those in employment in particular, we have a welfare system where people often turn to the private sector, private health, for example, private pensions and so on, but in a way which is subsidized through the public system or through pay-related elements like insurance, mortgage interest relief, tax relief, as was on gold-plated medical insurance and so on. So that's the first, and I think, so there's an overlap in the sense that there's a universal element, but there's, on top of that, this segmented welfare structure. What about participation? We did quite well in terms of starting to close that gap. The purple line there is Ireland from the early 1990s, right up to the crisis, with Denmark on the top. You can see the very high rates of employment in the labor force, or in the population in Denmark. Ireland closed that, but has dropped again in the wake of the crisis, which is really, but closed it reasonably well, but never got to Danish levels completely. Okay. And the other thing I should say there, and it's in one of the charts in the book, is that is linked very clearly to patterns of inequality, in the sense that if you look at one of the tables there, which links this to levels of education, you can see that the bulk of that employment gap since the crisis is in those with less than a college degree. That although there are problems for those with college degrees, in particular immigration, I think that the real problems in the labour market are falling on those below that level. Very significant differences, and that's accounting for most of this employment participation gap. So again, a case where equality and efficiency, effectiveness are very closely connected. I don't want to say too much about financialization. This is just a chart that's always worth showing for remembering how we got here. But I think the key point with financialization in Ireland is, so this shows that Ireland had a remarkably high percentage of corporate profits going to banks. The key element that I think that's worth emphasizing is that there is no normal to go back to in the banking system in Ireland in terms of funding productive development and industrial development. That Patrick Honan has a very interesting paper from 2006 which documents that bank-provided finance did not play any kind of major role in the boom of the 1990s. That much of the financing came either from private individuals or through state agencies, EU funds, and so on. So there's the sense that that there's a normal that we can get back to that would drive recovery. I think it would be misguided. So we're kind of working our way around that we've talked about. So the system of social protection, the labour force participation, and financialisation. And I just want to say a little bit about how the Irish system holds together in terms of what happens in the link between industrial development, economic development, and the state and Ireland's kind of fiscal situation. So just what this chart does is it clusters together the different types of capitalisms within Europe, and there's more detail on the individual countries in the chapter. And you can see on the right the social spending as a percentage of GDP. It just clearly shows that Ireland is clearly quite different from the Nordic social democratic countries. But the other thing that's interesting here is if you look in the middle, which gives you a R&D investment by private business, and also the learning organization of work. What that means is systems of organization of work that draw on the participation, the autonomous decision making of employees, that involve employees in teamwork and so on. So those kinds of organizations of work, that the productive dynamism, investment rates and employee involvement is also much higher in the social democratic than in the liberal economies. So again, there's an advantage here that derives from this more democratic, inclusive model. And the other thing that I think that's worth emphasizing is that even though the social spending is higher and the state is in a sense fiscally bigger, it's the smaller states that end up being more, if you like, fiscally reckless. And I think this is I think gives a different inflection, a different spin on the whole rhetoric around, which states have been reckless and so on, because that fiscal solidity, or the lack of the kind of fragility of public finances in the liberal economies and in the Mediterranean economies is also connected to other features of their societies. The fact that productive dynamism is weaker, the tax base is also weaker, the kind of steadying influence of the social security system has less of an effect, and so on. The Irish system is, obviously quite different from the Nordic system. On the other hand, I think there are elements that we can identify that may at least give us some potential for moving towards a more sustainable model. Not necessarily a Nordic model, but something which draws upon kind of some of those key elements. And the clearest potential here is, I think, down the centre, where we look across some of the agendas that have already been outlined within the policy system over the last 10 years. The NESC work in the mid-2000s around the developmental welfare state, which I think in a sense has never been properly picked up and institutionalized, but emphasized combining income supports with services and activation. So in a sense, although it didn't quite name it in this way, a more Nordic model of activation, and one which still offers us quite a useful alternative. And the flip side of that, something that I argued existed myself, was this developmental network state, which is a network of agencies that support enterprise development, industrial development, and so on. So Enterprise Ireland, IDA, and so on. That where there are certainly issues, but where Enterprise Ireland, within its own remit, has actually had quite a reasonable record. So there are kind of capacities within the system, or at least ideas within the system, that we could build upon. I think we're much weaker in terms of the stabilizing dimension. The social protection system, although I think we are also moving away from, in the context of austerity, removing some of the specific benefits, which may leave us with a very weak system, but also a more universal one. And on the financing side, where the Department of Finance is being actually more creative, I think, than people realize in terms of looking for new methods of financing. The danger there is that you end up back in the shadow banking system. But there are other dimensions also, talk of a state investment bank and so on. So that's simply just to say that there are elements within the Irish political economy that can be built upon. I think they all pose challenges. If you like, I would somewhat crudely say that the challenges line up differently for different actors. And I think, there's no obvious answers to these, but for example, for the community and voluntary sector, people working in social services, how do you combine protection and activation? For unions, how do you drive industrial development? Because often, especially in the Nordic economies, the unions are as much the drivers of industrial development as the private sector is. How do you combine that with protection of wages, working conditions, and so on? For business, how do you support upgrading in businesses and in a sense resist the temptation of cheap credit? And possibly most important of all, how do you get capital, the holders of wealth, who I would distinguish from business, to move towards investment rather than speculation? I think the key element for that is politics. And politics is really, these are all choices. They are choices that are difficult choices, but they are choices that can be made. The choices of any one actor depends on the other actors. And I think that's where the political system comes into play. Not necessarily in driving things through a grand plan, but through making it easier for the various actors to make these choices together at the right time and at the same time. The other level at which those choices can be made easier, just go into this, is in Europe. And I think this is areas where we have, where this is actually operated against, in the opposite direction, making those choices much more difficult. And I think that is linked, we can think about why that is by thinking about Europe as a mix of different forms of capitalism. And we have, in particular, the social market capitalisms of continental Europe and the Nordics, and then we have the liberal capitalisms, in particular of Ireland, the UK, and to some extent the Mediterranean. And they actually have quite different approaches. Macroeconomic management is more based on being very fiscally careful in the social market capitalisms, and in fact the people who are more likely to run a kind of a Keynesian deficit in the last 20 years is the UK. On the other hand, where does recovery come from? In the UK and the other liberal economies, you expect it to come from private investment inspired by confidence in the new situation. In the social market capitalisms, often, if you like, undercover, but it operates through social spending, whether that's kind of automatic transfers or whether it is investment led by, for example, KfW, the German investment bank, and so on, state investment bank. The problem is in the European, so each of those has an expansionary and a contractionary element. In the liberal capitalist model, private investment rarely actually drives economic recovery, so the expansionary element comes from monetary policy, currency policy, the Keynesian side of the equation. In the social market capitalisms, the fiscal consolidation is contractionary, slows down growth, so it's the state-led investment that drives growth, expansion, and recovery. The problem with the European model is that we have taken the contractionary elements from both and combined them into a European level strategy. And this is an experiment that is, I think, reckless, frankly, that in none of the individual national capitalisms do you see a model which actually combines both of these dimensions. And what that does is it makes it extremely difficult to generate any momentum for growth, to generate any kind of virtuous circle out of the kinds of choices that are present for actors. So that is what leaves us, I think, at the risk of the lost decade that people have been talking about. And I think the answer to that, to avoid that lost decade, and I think a lost decade for a country probably means a lost generation for those who are marginalized within that country, is at the very least we have to recover one of the expansionary dimensions, either on the macroeconomic side or on the investment-led side. And I think the classic European model for recovery will be one that is led by European-wide public investment. But I'll leave it at that.